My name is Jeff Deist. Keith asked me to speak to monetary metals investors, account holders, and interested parties today briefly on why I recently joined or made the decision to join monetary metals, how I see some of the macro issues going, and also how I see some of the business elements of the company going. So obviously, many of you might know me from the Mises Institute, where I spent the last 10 years. Prior to that, I worked for Congressman Ron Paul with congressional staff in Washington, D.C. And in both instances, I was focused very much on monetary policy, what's happening with the Fed, what's happening with interest rates. And of course, when Dr. Paul was in Congress, he had a subcommittee chairmanship, which was called the Domestic Monetary Policy Subcommittee. So he had opportunities to grill people like Benjamin Bernanke at least twice a year, Alan Greenspan prior to that. So I've obviously had an interest in economics and monetary issues for quite a while. If I've learned anything over the last 10 years, it is that, as Keith alluded to earlier, I think we've really almost lost sight or sense of what a dollar is, what money even is, thanks to government and central bank depredations. I think is very, very warped in people's minds. They almost imagine it that it is this magical thing that government can create, that central banks can create, and it can be thrown at problems, as we've seen most recently with COVID crisis, and that somehow this money production is costless. And of course, we all know that that isn't true. But nonetheless, we have a real problem in this country in terms of misunderstandings. What is money? What is debt? What is credit? Ludwig von Mises talked a lot about the difference between circulation credit and commodity credit. And Keith alluded to credit, which simply can't be repaid earlier in his remarks. So it's clear that the world needs something different in terms of value and in terms of trade. There's no doubt about that, but I'm largely in agreement with Keith's remarks about the de-dollarization. I think this is an overhyped phenomenon. I think this will be a very slow phenomenon. And I think in many ways, the US dollar, which we all think about a lot, worry about a lot, obviously, is backed by the biggest, baddest government on earth with the biggest, baddest military on earth, I suppose, at the end of the day, if we want to look at that kind of starkly. But I do agree that there are degrees of moneyness. I do think that there are better and worse forms of money. They can coexist, not always without some unease. But I think the idea of pulling a use out of gold, pulling a yield out of gold, and actually tapping into some of gold's moneyness properties is not only noble for those of us on this call who are obviously fans of commodities, but beyond that, I think it's just an excellent business opportunity. Keith has pointed out many times that there's tens of thousands of metric tons of gold sitting in the world all over the place. It's held by central banks. It's held on the balance sheets of public companies. It's held more privately on the balance sheets of a lot of private companies. And of course, it's held by households and individuals around the world. And most of it is just sitting there. And a lot of it is actually sitting in storage costing points. So the idea that we could pull some of this use from it is, I think, very novel. There's no other company truly in this space doing exactly what monetary metals does in terms of repayment in kind, in ounces, additional ounces. So I think that's an important factor. I also think that the idea that gold will not have a place in the future of monetary policy or in the future of monetary economics, that gold is a barbarous relic, that it's simply some sort of shiny pet rock at this point, I think that's incorrect. A lot of people in the Bitcoin space, for example, will say, well, the only point of gold was to tether debt, was to serve as a drag on government debt. And once they eliminated that tether, gold simply became something that's sitting around in some central bank vaults collecting dust. Well, if that were true, I think we would have seen gold lose far more value since, let's say, 1971 than we have. We still see a lot of demand for gold. We still see it hovering at about $2,000 an ounce in US dollars. And we still see central banks buying it up. So the idea that gold has lost its moneyness is a term Hayek used occasionally, I think is wrong. I think it still has moneyness, and I think it's never extinguished. So we don't care at Monetary Metals so much about the day-to-day price fluctuations in dollars of gold. If gold goes up, if gold goes down, we're trying to extract the use or the yield from gold, which already exists. And so obviously, if the price is going up, that increases interest in gold. That means people are nervous about the dollar or inflation. And that probably means that more people will be interested in the products we offer, certainly. But, that being said, we're not directly tied to that price. We're not selling gold. We're not touting that the dollar is going to crash and gold is going to go to $10,000 or $50,000 or $100,000. And if people don't want to part with their gold because it's going up, well, that's fine. But again, it's never extinguished. They're sitting on it. They're either paying storage or they're holding it at home. So we're trying to offer a practical use that actually pays yield. And we're trying to do that in a very savvy manner. In other words, we do a lot of due diligence on particular deals. We seek to insure against risk in all kinds of ways. And we have full transparency so people really understand throughout the lifetime of a transaction, a lease or a bond, what's happening, where their metal is. And I think we have a very transparent system. So I'm excited about the opportunity. Obviously, it was a bit of a departure for me to leave the Mises Institute after so many years, but I also wanted to get back into an environment that's a little more applied, let's just say. There's a lot of economic theory, but the proof is in the pudding. If somebody can make this work, if somebody can create a yield on gold, I think we're actually doing a service to the world in terms of pulling the moneyness out of gold. But I also think there's quite an opportunity for Monetary Metals and its shareholders to do very well as we scale this up. So I would just say that on the macro scale, I think we're in a very, very different time than we were in the 1970s, which is the last time the US government admitted to very high single digit, if not low double digit price inflation, CPI. Okay, now the difference between the 1970s and today is that, let's say your grandparents or your parents, they might have to pay 18% to go obtain a mortgage, but at the same time, they could get that same 18% on, let's say, a 1-year CD yield. So it was good for savers. It was bad for debtors. Of course, inflation's bad for everybody, but I mean, the high interest rates that some Americans are old enough to recall of the Paul Volcker era, late 70s, early 80s. Fast forward to today, the last couple of years, and inflation's been running, honestly, probably, 2 or 3 points above what they admit. But let's say it's running 8%. Well, you can only get anywhere from 1.5% to maybe 3.5% on that same 1-year CD. So you're not even treading water. You're losing to inflation every day of your life if you're in a CD. And I've never heard a good explanation for why over that 40-year period, we now have this huge delta between, basically an ordinary, fairly safe saving vehicle and the interest rate one might have to pay for a mortgage or the inflation rate. So very different time. And I would hasten to add that over that 40-year experiment, let's say from 1982 to 2022, when interest rates went relentlessly downward, at no point during that experiment did poor people, less affluent people, people who are subprime borrowers, people who have to, let's say, use those rent-a-centers or go to one of those car lots on the edge of town where you make a payment every week. At no point did poor Americans ever enjoy lower interest rates. They were paying the same 18, 20, 25% in some cases as subprime borrowers. So it certainly benefited the investment in banking classes, but average people and especially poor people, not so much. I think we have to understand that today is not only very different from the 1970s, it's also very different from 2007, 2008, the last crash. If you look at the response to the great housing bubble and the collapse of Lehman Brothers and Bear Stearns in 2007, during that uneasy period, the response to that was almost entirely monetary. In other words, the Fed, which had a balance sheet of less than $1 trillion, went into hyperdrive, quantitative easing and asset purchases from banks, and soon found itself within a few years with a balance sheet of over $4 trillion. So the response to the crash was almost all on the monetary side rather than the fiscal side. And what happened during that time, which I think does not go remarked on enough is that Congress fast-tracked something they were already working on, which was paying interest on excess reserves to commercial banks. This is absolutely unprecedented in U.S. history. And so once they started to pay interest on excess reserves, what do you know? Banks had excess reserves. Prior to that, they were almost fully let out. And of course, with the economic situation after 2008, a lot of people out of work, for example, the problem wasn't having adequate reserves. The problem was finding credit-worthy borrowers. So by this slight action, or this apparently slight action, the Fed basically went from its original purpose, which was a lender of last resort, which would provide liquidity and solvency to banks that were in trouble, but at a penalty rate of interest. In other words, they had to pay for their malfeasance. All of a sudden, the Fed turned into the lender of first resort, paying a premium. So a lot of commercial banks took the Fed up on the offer and said, yeah, we'll let you effectively recapitalize us. We'll sell you a bunch of your own treasuries, and worse, these mortgage-backed securities, you'll pay face value, even though 60% of those mortgages are set to, go into default or underperform any day now. So the difference between 2008 and let's say the 2020 COVID crisis was that the response to the latter was fiscal. So a big reason we see all of the price inflation we're seeing now versus some economists, even in the Austrian camp, were predicting huge inflation back in 2008. The difference is the fiscal response of the government to COVID. You have to understand that, first of all, we had direct fiscal stimulus, literal cash pumped into the economy by two huge stimulus bills, one under the Trump administration, one under the Biden administration. That $6 trillion was things like unemployment benefits, PPP loans to companies, direct subsidies to airlines and insurance companies, countless other industries, and a grab bag of congressional earmarks. So that $6 trillion was actually in bank accounts being spent, being deployed. So that was a fiscal response that was certain to drive up prices. So that's fairly understandable. What was less understandable at the time was that supply chains would remain botched for as long as they have. The politicians didn't think this through because they're generally not business people. We have this deeply interconnected global economy, and it doesn't just have an on-off switch. When resources or factories or ships or whatever are lying idle, it takes a while to spool those back up. And we still have shortages of all kinds of things. For example, new cars are still in short supply due to chip shortages coming out of Taiwan. So our politicians don't have any concept of structural production or the temporal aspect of that. So they don't really understand the whole idea of malinvestment. But here's an interesting little fact that I'd just like to mention before we wrap up talking about 2020. In the fall, in September of 2019, before any of us had heard of COVID, you might recall that there was a repo crisis in the markets. And the repo market is what commercial banks use for short-term overnight financing from each other. And embarrassingly, that market seized up and overnight repo rates spiked. So the Fed had to undo the slight amount of quantitative tapering it was doing and start quantitative easing very quietly. And this was, again, about 5 months before COVID, when the Fed really went into hyperdrive. And I thought to myself during that time, with all the increase in the Fed's balance sheet since 2008, with all those rounds of quantitative easing and all that base money put into bank reserves, how on earth could those banks lack for liquidity, borrowing from each other overnight in 2019? It just didn't make any sense. So I think a lot of Americans feel that things are not right. I think a lot of Americans understand that both on the fiscal and the monetary side, the economy is juiced, let's say, like Barry Bonds. It's propped up, that it's artificial, it doesn't feel real, and that maybe some of the prosperity, certainly that we've enjoyed with all the COVID stimulus, can't go on, and that we're going to pay a price for that. And I think that we are. I think that we are going to pay a price. And we're already seeing the Fed have to scramble with a whole new program, the BTFP, the Bank Term Financing Program, which is basically akin to, it's not identical, but it's akin to quantitative easing on the sly, whereby commercial banks who have old treasury debt that's not worth nearly as much as face value because it's paying 1 or 2% interest rates, and now treasuries are paying 4 or 5 or whatever they're paying. Banks are upside down on these treasuries, but they're able to borrow from the Fed at face value. So that would be akin to having an asset that you paid 100 for that's worth 60, and yet you're allowed to use it as collateral for a loan from a bank for 100, right? So none of this ends well. There's no telling how long it all takes to unwind. The geopolitics of all this are exceedingly complex. We're talking about 7 or 8 billion market actors getting up every day all across the world and trying to better their financial circumstances. So I think that trying to predict too much about dollarization or de-dollarization or a recession or a soft landing or a Fed pivot, all these things, it's very, very difficult because a number of moving pieces are so vast. And then you can throw in, let's say, a natural disaster, an escalation in the war in Ukraine, some sort of terrorist event somewhere. I mean, here's what we know about gold is that there are still huge demand for it. It's still retained its moneyness, at least in part, over many, many, many centuries. Central banks are still holding and buying it. And, at some point, I think Keith is going to be proven correct that gold will have a monetary use in the sense of being a financing instrument, in the sense of being used for lending and for collateral and as an alternative to the debt-backed currency that we suffer under. So all that said, I'm excited to be at Monetary Metals. It's a huge change of pace for me. I've known Addison for many years. I've known Keith Weiner and gotten to know him. I'm very impressed by some of the team members I've met, people with a lot of Wall Street experience like Saad. And I think that the infrastructure, the back end, all of the tech work with Bill and others on the team is really impressive. And I'm looking forward to really becoming a full-time member. I have a background in deal work as a lawyer in Big Four accounting firm settings. And I think that each individual deal we do in terms of the contracts, in terms of doing due diligence against the risk, geopolitical, financial, tax, environmental, whatever it might be, we're really going to streamline that and make that all go faster and better. And as a result, I think we're going to be able to scale up and do more deals and attract more gold investors to the company. So thanks very much for all of your time. And I guess we'll try to send things back to Keith.
Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com. See you next time.